Let's start with the bond inclusion in the FTSE Russell. It has been expected. What do you think are the implications longer term for Chinese assets?
Yeah, good morning, gentlemen. Thanks for having me on. I think this FTSE Russell inclusion has been anticipated by the market for a while. I mean, even this week, the trading hours were extended to 8 p.m. Hong Kong, Shanghai time. So people are getting ready for it. Foreign investors, even though they only hold 3% of the onshore China bond market overall, they already hold 10% of the onshore China government bond market. And we saw even fund managers like CSOP had already created a China government bond ETF on the Singapore exchange ahead of this anticipated FTSE index inclusion. And it already attracted $675 million US. So people are anticipating this. It doesn't really start, the actual inclusion gets validated in March, and it doesn't start until October of next year. But we do think it will attract another $140 billion US of foreign investments into the Chinese government bond market. And I think the implication is that this FTSE WGBI index is widely tracked by passive investors globally, including in very large countries like Japan and certainly the US. So you're going to see some new pockets of money come into the Chinese bond market. Implications on FX, you kind of mentioned it already. It will have a strengthening effect on the CNY. On the rates market, not as much actually, because there's two-way flows because you have lots of onshore investors as well. And the equity markets may be a slight shift away from equities into bonds, perhaps. But one thing I'd like to point out is, very interestingly, this week as well, the Chinese government just approved 3.36 billion of QDII quotas, which will allow onshore investors to buy offshore assets. This kind of shows a willingness of the government to open up two-way flows again. Maybe because the dollar renminbi has been on a declining trend, so that they feel a bit more confident that they can let some money leave the country again. But I do
that
believe
is a development worth monitoring, isn't it, George? Can I just get your views, George,
so.
on the Evergrande? Can I just get your views on the Evergrande story, George, before we move on? In terms of, I won't ask you to talk specifically about this name, but in terms of the broader implications, in terms of systemic risk, is this a red flag for you? Are you concerned about the implications potentially of this?
I am, actually. It's a little bit like a canary in the coal mine. I think I was just looking at this. Since the beginning of the year, the Asia credit markets are considerably tighter than pre-COVID. For example, the Asia ex-Japan investment grade index is 5.7% higher in price than the beginning of the year. The Asia ex-Japan high yield index is 3.7% higher year to date. But I think it's very hard to argue that credit fundamentals today are better post-COVID or in the middle of COVID than beginning of the year pre-COVID. So I think there could be some more selling off between now and the end of the year. I would say similarly on the equity markets. I think both equity and credit have rallied probably a bit too much beyond the pre-COVID levels. Largely due to the $3 trillion of dollar liquidity from the Fed or fiscal stimulus from countries all around the world. But now people are getting a bit concerned. Vaccine may be delayed till next year. Governments are hesitating, like the US, are hesitating whether to implement another round of fiscal stimulus. Businesses are suffering from over 6 months of COVID. So now you're really seeing corrections. So not only 10% decline in the S&P 500 almost, I think there'll be more corporate defaults. And some other signs as well. I mean, there's been a recent 10% drop in the gold prices. Gold is interesting because it's usually a hedge against risk assets. But with excess liquidity, it becomes correlated with risk assets. But then base metals also declined about 10, 11% recently, like iron ore, which reflects actual lower industrial demand. So all these things together kind of tells a risk-off sentiment, I think. Now going back to what
George,
go ahead.
Right, George, I wanted to pick up on just what you mentioned there, because, I mean, obviously you have a fairly wide coverage in China, so I'm going to keep this next question fairly open-ended and purposely vague for you. You look at what's happening in the economy, you look what's happening in markets. What is the most exciting thing in your view in China? What's the best trade in your view right now?
Well, I think it's. I actually think it's the renminbi trade. Actually, we had a call back in June that the dollar renminbi, it was about 7.1 back then. We actually felt strongly it would the renminbi would appreciate and dollar renminbi would come down to 6.8, and we're kind of there right now. We're forecasting now that between now and the end of the year, it's going to come down to 6.5 actually. So that's pretty aggressive. That would probably imply a bit of dollar weakening as well as renminbi strengthening. So I think that's probably probably one of our higher conviction trades for the rest of the year. I think on the rate side, I think you were mentioning earlier that the wide gap, this wide gap between, let's say, 10-year Chinese government bonds and U.S. Treasuries, so it's 240 points gap, 240 basis points gap right now. We think that's going to stay there for a while. We don't think that's going to close anytime soon. I mean, the U.S. has said, Fed has said, is not really going to increase rates for 3 years. The Chinese policymakers, they don't look like they're lowering rates either. If anything, rates may even creep up a little bit more in the coming months. So, kind of this carry versus volatility is very, very attractive right now, especially if the currency is stable, right? So, I mean, like you said, China's a single A-rated country. When the Japanese 10 years at 0%, Germany at minus 0.05%, and even emerging markets are lower in yield. South Korea at 1.4%, Philippines at 2.7%. It's just a relative value in a local currency basis is very, very attractive right now. So we think this percentage of
right. No, right. So, I mean, that then takes us as a final question to you is, with the Fed where they, Fed's going to stay where they are likely for 3 years. That's the current thinking. If you think, and to your point, if you think the exchange rate in China goes to 6.5, I mean, is that another way of saying that PBOC raises rates next year?
I'm not sure it really feels the need to raise rates, actually, because the economic, I guess rates may actually naturally move up a little bit as a response to the economic growth that we're seeing. Because I think what we're really seeing is a really diverging story now in economic growth between among China, U.S., Europe, and the rest of the world. I mean, if we keep it very simple, it's really based on fundamentals, how we've been affected by COVID around the world and how governments have responded to it with monetary and fiscal policy and how business environments have responded as well. I mean, in China, we're forecasting plus 5.5 GDP growth in Q3 and plus 5.8% in Q4. So we're forecasting a little bit higher than the Bloomberg forecast. We think it's going to end up being about plus 2.5% GDP growth for the full year of 2020. But conversely, the second wave of COVID is really hitting Europe very hard. I think UK just had its highest day of new cases of COVID since the pandemic started. So we're forecasting kind of like minus 9.7% GDP for the UK this year, minus 9.8 for France, minus 10 for Italy, minus 5.6 for Germany. That's about as good as it gets in Europe. And US, we're forecasting about minus 4.2% GDP growth for the full year of this year. Plus, you add in the potential stalemate of a potential fiscal stimulus package because, maybe no one wants to do it before the presidential election in November. And then it takes time for the stimulus to kick in. It could be pretty challenging the rest of the way this year. So, and also one more thing about China, they're about to do their 5-year plan. The Chinese Communist Party Central Committee is going to meet next month to discuss their 5-year plan for 2021 to 2025. And I think we're going to hear a lot more about this dual circulation model. So on the one hand, I think they really want to focus on creating some new growth engines domestically. But on the other hand, they want to continue opening up its markets to resist efforts to so-called decouple it from the global economy. So I think this 5-year plan is going to include things like key elements of national security like technology access, supply chains, food and energy access, and really focusing on stimulating domestic demand just in case some of the international flows get compromised a bit.